Hey guys, it's Alloy, as usual. So I wanted to take the time to make this video to talk about something a little bit more in-depth and complex, because I hope after watching a couple of the other video tutorials that you're sort of on the same page about some dynamics in the general market. So, and when I say the general market, I'm talking about two dynamics that work together at all times or are intrinsically united. It really depends on how you look at it. But in a nutshell, you have stocks and contracts, right? And the contracts, hopefully by now, by the other videos, education, you've learned that contracts are really just like they are in any other context in life. There is an agreement. There is some kind of stakes at hand. There are some kind of stakes at hand. But we'll go ahead and kind of isolate this down to just how it applies to the market as a refresher. We have time, price, and expiration date. Those are the three variables that over your relationship until expiration with that contract determine its value, right? Now, what happens when a contract reaches a certain price by expiration? The person who wrote it has to sell the number of shares agreed upon for that price at that date. That's the nature of a contract. If it does not reach the price at that date, at the expiration date, then the person who sold the contract for X amount of money gets to pocket that premium they sold it for, and they don't have to sell anything because the terms of the contract were not ever met by the market. Okay. So now that we've kind of got that down and reminded ourselves of what contracts are and how they work, let's talk about who is buying contracts and what that volume means for average traders like us. The people who are buying contracts are generally large firms or very wealthy individuals in a more rare basis that are hedging their bets most often with puts or calls. But when a market is going up, we like to hedge with a couple of puts. Now, let's talk about the motivations. Again, just as a refresher, these are all three things. On the second one, about to bridge over to the third point here. These all 3 points were made in previous videos, so really just refreshing again. This last thing is people do not want to have to sell their shares. So getting up to that expiration date and that price connected to that date is really something that people don't want to happen. So when writing a contract, they select one that they think is relatively unlikely to be met. And when it gets close to that, they kind of shake in their boots. They start to get a little sweaty. Now, what do really wealthy people do about that? That's not a question you and I might ask ourselves, because when it comes to the market, we really only have the chance to hedge. Now, they've already done that by writing calls because, like I said, they want the money and the money. They're making money when the shares go up in a bullish market, and they also want to make money when someone else is making a haphazard bet if the market is overly bullish, and if the market is, overly bearish and they happen to disagree with that, then what they'll do is they'll write puts. So these are all just different hedging strategies that they use, but they have a lot of control and measure over this. And what that allows them to do is actually, in a large way, control the price movement within a certain frame of time and volume, sort of the breadth or the gap that they're able to mediate the price between. So not that all of that to say they cannot make the market crash, or I mean, if they could, it's not really the goal of anybody to do that. I really want to tread carefully about this topic, because when I talk about market manipulation and market makers, it's not some grand conspiracy. It's very calculated, it's quantitative, and in a lot of cases it's intentional. I hesitate to use the word planned. I think it's sort of just organic and happens over the millions of dollars of liquidity that are constantly flowing back and forth, and where everyone's psyche is and where they want prices to be met. That ultimately determines the scale of bullishness beyond bubbles and euphoria. And since we're not really in either of those things technically right now, a lot of people will say we're in a bubble, but the technicals don't really validate that. The technicals say that we're being quantitatively eased by the Federal Reserve. So we're not really a bubble unless you count inflation. So without going too far into those very complicated topics, though, let's talk about this fantastic secret that is overall the topic of this video. How do you use this information to tell what the prices are and are not going to be weeks or months from now? Real quick, let's look at something that is constantly revered as a way to measure the market as a whole, which is SPY, right? So what we can do here is look at these contracts as we always do in options calculator, which, if you didn't know, is what we're using now. So one of the most important things here is the volume. We can tell what people are doing and what they're writing, what the market believes about the SPY, the S&P 500, based on the volume, the context that we can get from that. So while we're on this video, let's go ahead and look at the SPY, 382.5, right? That's what they are writing calls for. So right now we are at 375. Now, what does this mean? Like I said, I was making that point about what options writers prefer and how they like to manage their assets. They don't want to sell, right? Those little tidbits of information. What this means is that 382.5 is very, very unlikely to be achieved by today. Very unlikely. Now that's sort of obvious, right? And that is of course the highest volume one because it is the one expiring today. It's for this month, just for right now at least, the most popular one. But if we look at the next one, the 25th, so that's next week, I think Wednesday, right? So the volume's almost as high, only 1,000 less, and it's 383. So again, because options buyers are 90% of the time wrong, which we've discussed in our dark pool video, and because the people writing them are generally very wealthy people who are frankly wealthy enough to own 100 shares of the SPY, which right now would be 37 grand, right? So not small money and not simple math either. These are people who have the money and the experience to write contracts like this. Those people are educated enough to write a contract that says they don't think it'll go to 383. So a lot of people, a lot of noobs especially, if I could use that word, probably look at volume and think, ooh, I want to jump in on that because everyone else is. No, don't do that. You're going to have to look at your own strategy, your own will, and your own methods, because what this volume actually means is simply these are the contracts that were written the most and purchased the most. A couple people are buying these contracts based on just selling premium in between when they bought it and the expiration. So they don't think it's going to be 382.5 by this day either. They're just trading on the premium in between that time and dumping it before it becomes worthless. We've all done that before. So no shame in that. That is kind of gambling, right? You're playing with your odds. You're playing with time. You think you're smart is what you're doing. Now, there is that approach, and we've all done that before, that sort of gambling fun stuff. But still, ultimately what that means is it expires worthless. Okay, so let's take a more, let's see, a greedier approach. If I could, again, use some liberal terminology. We have some other rights, and we'll see the volume decreasing and increasing depending on these strikes. We see 390, which is the highest of all, has high volume. So we really don't want to pay attention to that because it's already higher than what we know the options writers don't think it will go to. But if we look at something like 381, oh, okay, so that's pretty much the highest they think it will go. The highest. Now, let's look and compare this number. Well, let's look at another page. Let's see if there's anything lower. 81. So it doesn't look like there's quite a bit of confidence around 81, actually. Any lower than that, and the people writing are not so sure. By today, they think it could have gone up by this much. I think right now we're all a little bit more certain about where we'll end. But when these were written, these were the best guesses by very rich, very smart people. So 381, let's compare that to something. Let's look at, it really doesn't matter, but TA, 381. Okay, so bullish would be 380. And that's right in between bullish and testing, right? So that validates exactly what we're seeing in a lot of cases. You could say, oh, a bull kick 3 days ago. And I want to say, I'll take the time to mention just how proud we are of digits, because we now know that since the 19th, the SPY has gone up a pretty predictable amount. Fantastic information everywhere you go on the dashboard. So just a kind of a scenic route sort of thing. We're not really talking about bull kicks here, but the Fibonacci retracement, 381, and we see 380 is bullish. So that's right in between bullish and testing, you know? So this is validated everywhere you go. You can look at this volume information, look for where there's still a lot of contracts being written, but there's quite a low price. So the first thing you want to do is, and let's go ahead and use this exercise on something like AMD, which is popping off right now. Same thing, let's search for it using really wide open metrics here. Look for high volume, and let's look for the lowest one in this high volume category, 91. So this is interesting. You know what this means though? It means a lot of people are getting written on, and that's why they're all red. All these ones. Now you could buy these, but there's no certainty they'll be worth anything by the end of the day because the IV is already so high. But this is pretty interesting stuff. Now you could use this, let's change the dates a little bit. Start date 22nd, let's make it, because what we're gonna do here is we're going to see a little bit more discreetly what people think the future of AMD looks like. Here we go. So what I just did is I changed the date so that we're not including things that are expiring today anymore. So next week, people think, really rich people think that we're probably going to be hovering around the same prices. The ones that are still making people, both writers and buyers, money are these ones. But all of these ones are pretty much going to die worthless, the market thinks. So that's very interesting. In theory, next week, AMD will not go much higher. Right? That's basically what we can take from this. Now let's go ahead and look at TA. Do the same thing with AMD. Because I'm not afraid to show if this works or doesn't work. It really is more important to me to get it right. Okay, so 95 would be bullish and testing is 97. Now average is 92 and near 93. Resistance is 91. So we do have a bull kick, but now we have a bear kick after that. AMD is going up, and we're pretty much at these bullish and testing levels. So again, it makes sense. Let's do one more thing while we're looking at AMD, and let's just see if it invalidates or validates what we're saying. Now keep in mind, movement predictor is only 1 day in advance, and we have a weekend coming up. So the bullish prediction is 100, bearish is 97, average is 99. So this information combined, you have two things telling you that AMD is going to struggle to hit these triple digit numbers that this might be predicting. This bullish 100, it's looking like that might be a little bit unrealistic. And also we know that movement predictor is only 24 hours in advance, and it has difficulty on weekends for that reason. All this information combined, you might know that writing on AMD next week is a pretty safe bet. Rich people are doing it, so why not you? I hope this helped. I think that I'm going to write on AMD next week. I have 100 shares. I wrote on them this week, so assuming I don't get assigned on my 95 call for today, I will do the same thing next week with this information. Join me if you want. I'll be taking a cautious approach, maybe writing closer to 99, 100, because sometimes digit surprises us, and AMD can always jump, right? So let's also look at the discounted cash flow value. It's 94.6. So I know what I need to know now. I'm going to write for about 99, 100 next week and take that sweet, sweet premium while we still have high IV on Monday or Tuesday. Again, guys, I hope this helped. This is probably one of the cooler, more cheat codey tutorials that really guide price movement for me every week. And I think it just slipped my mind. I forgot to record it. So have a good one, guys.